Hi, this is Tim Kelly from LTC Breakthrough, and thank you for joining our free educational webinar series entitled Long-Term Care Insurance 101, the Basic Building Blocks. This is part 4 of a 5-part series, so if you have not listened to the first 3 workshops, please go back and watch those now before proceeding to this one. Remember, you can go to ltcbreakthrough.com to request an individual phone consultation. I would highly recommend that you speak to us prior to purchasing any long-term care insurance. So without further ado, let's begin our seminar. So the basic building blocks of any long-term care insurance policy are the following. They are your monthly benefit, the benefit period, the elimination period, the inflation options, which we're going to be discussing today, and the benefit triggers. Again, if you haven't watched the first 3, please go back and do so now. So let's talk about inflation coverage. There are several different types that are offered in long-term care insurance policies. Generally, most insurance companies now offer 3% or 5% compound, or 3% or 5% equal. Now, the 3% or 5% compound are more expensive than equal, and that's because it offers compounding, or what you would call interest on interest. So if you have a 3% compound inflation option on your policy, your monthly benefit and your lifetime maximum would both grow by 3% every year. And so if you had, as an example, a $1,000 monthly benefit and it grew by 3%, that would be $1,030 next year as your monthly benefit. Now in the following year, in year 3, it would take 3% of the $1,030. So that would be more than 1,060. It might be 1,062. As an example, I don't know if that's the exact number, but it's going to provide interest on interest there as it compounds, as opposed to equal in our example, which would do 3% of $1,000 every single year. So it would grow by $30 every year. So what it would grow at a slower pace than the compound inflation option. Now, why is inflation important in a long-term care insurance policy? Well, because if you buy a policy today, you may not need that policy for 10 or 20 years before you actually need long-term care. Now, we know that long-term care services are very expensive. However, what they cost today will not be what they cost 20 years from now. So you know the cost of care will continue to increase every year until you actually need that care. So we want your benefits to keep up with the actual cost of care. So once again, your monthly benefit and your lifetime maximum will both grow by the inflation option that you select. Now, 3% and 5% compound. 3% compound is the most popular right now. The costs of care are generally growing at about that rate. So 3% compound should keep you up with the actual cost of care growing in our country. Most people don't purchase 5% compound anymore because it is very expensive. The 3% or 5% equal can come into play. 5% equal has about a similar growth to the 3% compound. So depending upon your age, you may want to use 5% equal instead of 3% compound. That's why an individual phone consultation is so important when deciding on things like this. We can show you the growth of both so that you can make a good decision about which one you want to purchase. Finally, there is one other option offered by most insurance companies today for inflation coverage, and that's called a guaranteed purchase option. Some companies call it a future purchase option. And basically what that allows you to do is you don't have any automatic inflationary increases, but at predetermined times, the insurance company will make you offers to increase your coverage without any underwriting requirements. So regardless of what your health is at that point in time, you can purchase additional coverage at predetermined times and predetermined amounts. So as an example, one insurance company may offer every 3 years that you can purchase 15% more coverage without any health underwriting requirements. So you are guaranteed to receive that if you decide to purchase that. Now, while there's no real built-in price for this option, if you do decide to purchase the additional coverage, you will be charged for that coverage at that point in time. Now, this can be the most expensive type of inflation rider because when you purchase that additional coverage, you are purchasing it at your current age. So as an example, if I purchased this at age 55 and I got my first offer at age 58 to buy 15% coverage, and I elected to take that offer, I would be paying for that additional 15% as a 58-year-old. So it will be more expensive. And if I am planning on taking that every single time, it will be more expensive than the automatic inflation options, the compound, and the simple inflation options that I told you about on the previous slide. Using the guaranteed purchase option sometimes makes sense if you have a limited budget in the beginning, so you can keep your price down by not adding automatic inflation and taking these purchase options in the future as you want to add coverage. However, again, if you're adding these every single time, it's going to end up being more expensive than the automatic inflation options. Thank you. Once again, my name is Tim Kelly from LTC Breakthrough. You can reach us at 888-909-8833, or you can go to ltcbreakthrough.com and request an individual phone consultation, or you can email me at tim@ltcbreakthrough.com. Remember, I've put a link to ltcbreakthrough.com below in the description, so feel free to click on that link and go there right now. Thank you again.